Hello, this is Ryan Mallory for SharePlanner.com. Today I want to use this opportunity to go over one of my trades that I got stopped out of this morning, and that is SCSS, Select Comfort Corp. Trade did not go at all my way from the very get-go. From the entry to the way that I managed the downside risk, I could have done a better job in. So what originally drew me to this particular trade was the ascending triangle that you have marked by these purplish lines. Right here you have a very nice trend line moving up, and then you have a resistance level that's been tested, about 10 times on the daily charts, that shows that it just can't move higher than that particular level. So what becomes even more compelling about this stock is that when it does actually break through, and for me it was at 938, if it broke through that level, that would be a good sign for me to go long in it, and it did. I got an alert. I put my order in. In fact, it moved so fast that I didn't get the entry price that I wanted at 938. So I saw it go all the way up as high as 948, which is about 1% above my entry price. I did not get in at that point. I waited for it to come back down, and it did come back down. If you look at the 5-minute chart here with me, you'll see I wanted to get in probably around right here, and it just shot right through. It goes all the way up to 948, and this is primarily due to all the stop losses, because you had a lot of people trying to short this stock, and once that 938 level was broken, the shorts started covering their positions, and that's what caused this huge spike. Now, what we like to see on breakouts is there to be a sustained a rally. So not only do the stops get hit, but the stock itself can hold those prices and continue to march higher. And right here you see SCSS come right back down to the 938 level. I get in it at that price, but it doesn't hold for very long, and it just continues a steady march downward. So at this point, I'm becoming very concerned about the trade. And going back to the daily chart, you can see that this candle right here, which we haven't seen the entire time in this pattern, is a huge glaring head fake. All right, it did break out, but it couldn't hold. It comes right back down, and that's why it fakes out the buyers, and it takes out a whole bunch of stops in the process. So it frustrates bulls and bears alike. So at this point, I should have. Well, let me go over first the reason why I stayed in the trade. I stayed in it because it was still very close to the breakout level that I was wanting to see it push above. And you can see here that there's been a lot of pressure building, but just by the very simple fact of how magnetized price seemed to be to that resistance level. It wasn't hitting this trend line very much. Instead, it was just stuck to this resistance level. So I felt like the chances of it dropping way down was minimal. And but the one thing that I should have taken into account was this candle and how that would affect the next day's price action, because it closed at 921 and my stop loss is at 901. It's a $500 million market cap stock, and if the stock opens at all down, it's probably going to take my stop loss out. And from what we've seen in the market from recent days, even if we have some decent gains going into the open, the market tends to sell them off. So all that I should have taken into account, but I didn't. I honed in on the one fact that it was magnetized to that upper resistance level, that it still showed signs of wanting to break out just based on prior price action, and so I stayed in it. But what ended up happening today, as soon as that market hit, I took the 3.9% loss on it. I had my stop at 907, and it just shot right through that. The bid and ask spread was pretty wide at the open, so I get out at like 901 or 902, and as a result, I'm taking on a bigger loss than what I really wanted to take, and then two, I could have avoided all of today's loss and simply walked away with maybe like a 1 or 2% loss overall on the trade. Instead, I'm walking away with 3.9%. So even as long as I've been trading, I still make plenty of mistakes. And looking back at this, reviewing my trade, this this candle was such a glaring warning sign about what we might see the very next day. And instead of heeding to that warning, I held on one more day. And and quite frankly, too, nobody likes to get into a trade, on a breakout that they think could, last, a few days, and then have to get out the very same day because it's just not working. And there could have been some pride and ego there in play as well, and I should have recognized that as well. But I was choosing to take the optimistic route, and instead of uh, heeding this warning sign here, I held on for an extra day and paid for it. So in any case, I hope that you all can learn something from this mistake that I've made. It'll make the loss, feel a little bit better, I guess. But nonetheless, you got to pay attention to what the stock's trying to tell you. You want to be able to keep the losses small. And yeah, 3.9% isn't a huge loss, but I don't really even like that sizable that kind of loss. I like to keep it 1% at most. So that'll conclude this trading recap, and there'll be plenty of these in the future too, I'm sure. But for now, learn from my mistake that I've made. Try to incorporate this lesson into your future trading, so that when you see these kinds of warning signs, this head fake, that you don't repeat the same mistake that I just made.